Welcome back to our second presentation on stocks. And in this presentation, we will discuss the mechanisms for trading stocks, for allowing transactions, the securities marketplaces, as they are called. Some indices, some measures of the stock market, how we determine how well we're doing. And then we'll take a look at specific measures for individual stocks. And we'll start the process of what is sometimes called stock analysis, securities analysis. And I hope that you will find that it's really not as hard as people make it out to be. There's a whole world of people who want you to believe that you'll never understand how stocks work and how to value them and how to make prudent, long-term oriented decisions in the investment world, and they're absolutely wrong. But you got to pierce the veil, and that's what we're going to start to do today. Slide number 19. What is a securities marketplace? With the silly name, securities. Well, that's the fancy word for a financial investment. In fact, the BUS121 class we now call Introduction to Investments. We used to call it investments and securities. And people would say, I'm not an administration of justice major. No, not that type of security. A security is a tradable instrument that represents either ownership, a stock, or represents a loan, that's a bond. And then there's a few other versions of securities, but they're financial investments. And there's places where these things are bought and sold throughout the day. The granddaddy of them all was the New York Stock Exchange, the big board it was called. And this is a centralized location on Wall Street where brokers would get together and scream and holler at one another and buy and sell these stocks. Well, guess what, folks? There's very little of face-to-face interaction anymore. They're a tiny little bit. Virtually everything is done by computers. So you don't have to be sitting on the floor of the stock exchange to trade shares. You can be anywhere around the world, and people are. So much so that the New York Stock Exchange has become sort of not that important. In fact, it was bought by a company in Atlanta that didn't even exist until the year 2000. Just recently, a few years ago, it was bought by Atlanta. Forget the name. Intercontinental something or other. Yeah. Bizarre. And then the American Exchange was right down the street from the New York Stock Exchange. In fact, it started outside the New York Stock Exchange on the curb. And that's why people called it the curb. But now it's owned by the New York Stock Exchange, and the New York Stock Exchange changed its name from American Stock Exchange to New York Stock Exchange MKT. MKT, or I guess that's market, I don't know. Why? Oh, who knows why, because the American Exchange was always really, really small compared to the New York Stock Exchange. But the new kid on the block is the NASDAQ. The National Association of Securities Dealers Automated Quotation System. Well, they don't want you to remember that acronym. All they want you to know them as is the NASDAQ. And it's all uppercase. Figure that one out. And the NASDAQ was a place that started in the 70s, all electronic. There's no centralized location. There's no place where people are screaming and hollering at one another. It was all computerized. And interestingly enough, many of the computer companies that started up in the 70s and the 80s, like Apple and Microsoft and Oracle and Dell, they decided they would start on the NASDAQ. And the idea was once they got large enough, they would move over to the New York Stock Exchange. Once they got large enough, they said, you know what, we're happy on the NASDAQ. We're going to stay on the NASDAQ. And you could hear two words in the 19th floor of the Wall Street New York Stock Exchange. The first one was O. The second one was now there's a race. And these companies are trying to get bigger and bigger and bigger and swallow up smaller companies, smaller trading places around the world. It's a urge to merge. And then there's the over-the-counter markets. Did we talk about the penny stocks, folks? Yeah, well, this is where those are traded. The New York Stock Exchange, the NASDAQ, they want nothing to do with these companies, folks. But the bulletin board and the pink sheets, now I think they call the pink sheets the over-the-counter markets. Over-the-counter market or something like that. These are places where the riffraff live. The wrong side of the tracks, the red light district. Stay away from the companies on the bulletin board and the pink sheets. And so let's read together. For hundreds of years, marketplaces were, and still are for the New York Stock Exchange and the the NYSE, it's the same building, centralized locations. But with today's technology, the vast majority of transactions now occur electronically. The centralized locations are still in operations, but very few transactions occur there anymore. As far as I'm concerned, the only reason they keep it open is so they have something for television. That's my, I don't know, maybe I'm wrong, but it looks like that's all it's open for, because you see them, they're standing around and not doing anything. There's a couple people trying to make deals, but for the most part, they're just standing there looking pretty. Slide 20. How do we know how we're doing? Well, we use what are called indices, stock market indices. To gauge the current condition of stocks in general, financial professionals have created various stock market indices. It's just a list of companies. It's a list, that's all it is, a list of stocks. And the one that you hear the most about is the Dow Jones Industrial Average. The Dow went up, the Dow went down. What the hell does that mean? Well, all it is a list of the 30 largest and best known companies. That's all it is, folks. There's nothing spectacular about it. And it's been around since 1896. I think that's why it's the most popular, because it's the one that's been around the longest. Who is Dow, by the way? Dow Jones. It's the company that publishes the Wall Street Journal, and it used to be privately held for over 100 some odd years, and now it's owned by Fox News. In fact, my understanding is Rupert Murdoch, who runs the empire, he didn't really care about the Dow. All he wanted was the Wall Street Journal. He wanted to own the Wall Street Journal. So now the Dow is no longer, I'm not sure I quite understand, but I think it's being managed by somebody else. I think it's actually being managed by the next company, and that is Standard & Poor's. You ever heard of Standard & Poor's? They've been around a long time, and it's the same company. It's McGraw-Hill owns them. Same company that made your textbook. They make a lot of textbooks. They make a lot of money off of textbooks. And they own radio stations and television stations, and they also own, McGraw-Hill owns Standard & Poor's. So Standard & Poor's, we saw them in the previous chapter when they are one of the companies that rates bonds. Well, they also have the very famous index called the Standard & Poor's 500, and we'll see that in the next chapter. That it traditionally is the 500 largest companies in the United States, the blue chip companies, the income, some of them are cyclical, but the big companies, large companies are in the Standard & Poor's 500. And this one is actually more important, in my humble opinion, than the Dow, because the Dow's only 30 companies. By the way, before I continue, right now in the face-to-face class, we would do an instrument together, the stock investing over the 82 years ago. So it's on the website. I want you to do it. Look at the left side. Don't peek. Don't look at the don't peek part. Look at the first one, and then listen to the commentary, and then decide which one, which stock you want, and then peek, and you'll see how well you've done for the 30 companies. But the Standard & Poor's is a much more important one, in my humble opinion, much more useful, and we'll come back to it in Chapter 13 because many mutual funds use the Standard & Poor's 500. What's the NASDAQ? Well, the NASDAQ is that place where the high-tech companies are, right? So the NASDAQ has their own index that is mostly comprised of high-tech companies. Not all. Costco and Starbucks, they're on the NASDAQ. So are they really tech companies? I don't think so, but still. So most of them are that's where Apple and Microsoft and Intel and Oracle was there, but then they moved to the New York Stock Exchange. Facebook, Twitter is actually on the New York Stock Exchange, but mostly it's comprised of high-tech companies. So you hear on the news, the Dow went up and the Nasdaq went down. What are they saying? Well, the big companies, or the S&P Standard & Poor's 500 went up, and the Dow went, and the Nasdaq went down. Well, the big companies, the old guard, they went up, but the new technology companies, they went down. That's what they're talking about. And they're just looking at a list of companies and averaging the price. Those are the three biggies. You may see some others, and we'll quickly go over these. The Dow Jones US Total Stock Market Index, which I think is a very stupid name. It used to be called the Wilshire 5000. It was approximately 5,000 stocks. Actually, it's more, but it changes. And this is meant to take a look at the large companies, which is the Standard & Poor's 500, plus the medium-sized companies, plus the small companies. It was designed to gauge the entire stock market. And it sounds like, wait a minute, there's 5,000 stocks, but only 500 in the S&P 500. But those 500 in the S&P 500 make up 80% of the total market value. So 500 companies make up 80%. The other 4,500 make up about, 19. And then there's a bunch of companies that make up 1%. A lot of companies are worth, nothing compared to the big companies. So the idea was, let's see how the entire market's doing. But realize that the Standard & Poor's 500 is much. It wags the tail of the dog. It's the important part, where the other guys are the tail. They're not that important. And how do we take a look at just small and medium-sized companies? You may every once in a while hear about the Russell 2000. You don't hear about it too much because, as we said, they don't really represent that much of the value of stocks in the United States. I mean, they're important companies, don't get me wrong. Small companies, every large company was originally a small company, but by definition, but these don't really amount to as much of the action, if you will, in the stock market. Although there are some people who say this is where you should be because these companies have the potential to become very, very large, and they're absolutely true, folks. But they also have the potential to fall into the porcelain oasis, because when the organic matter hits the ventilating device, I've used these phrases over again, haven't I? When things go bad, the small companies get destroyed. The large companies have the roots deep in the economy. They can withstand the storms. These companies get blown away. Now, how do we look at outside the world? It's becoming more and more important. Well, about late 1960s, early 70s, a mutual fund company, actually, believe it or not, but they don't own it anymore. They started the World Index, and that's why it's called Morgan Stanley Capital International. Capital International was part of the mutual fund company. It's actually called the American Funds, but that's not what they call themselves. And then they sold it to Morgan Stanley because they didn't want to have a conflict of interest. They're measuring the gauge that they use to gauge themselves, so they sold it off. And for many years, there were two of them. The World Index, which was the global stock market. That included everybody, including the United States. And then the EFA, and that's how it's pronounced, Europe, Australia, and the Far East. And that was everybody except for the United States. Well, now they've changed the names and changed the characterizations, which I understand, but I wish they would have come up with a better name. The problem with the World Index and the EFA Index is that they just looked at the developed world, as it's called now. We used to call it the First World, which wasn't a very nice name. Well, not nice to call the Third World. The Third World, there's only one world, folks. But that was the United States, Canada, Western Europe, Japan, Hong Kong, Australia, Singapore. So developed markets with mature industries and mature stock markets. And so, but now, the developing world, as it's called, it used to be called the Third World. The developing world has gotten big, and it's part of the world. So now we call the index that looks at everybody the Morgan Stanley Capital International All Country World Index. Dumb. And the one that is everybody but the United States is the Morgan Stanley Morgan Stanley Capital Index I'm sorry, Capital International. Oh, don't worry about it. I'm getting confused. Don't worry about MSCI. Don't even worry about that. All Country World Index ex-USA. Ex-USA means outside the United States. So what that does for us, it allows us to look at the entire world as an entity, and then allows us to see how markets are doing outside the United States. And we'll come back to these in Chapter 13 when we discuss mutual funds. So, do you have to memorize these? No, don't. Just write them down so you can at least you could identify them. You don't have to remember them from memory, but so you can identify them and say, oh yeah, Russell 2000, small companies. Dow Jones US Total Stock Market Index, Wilshire 5000, everybody in the United States. World Index, everybody in the world. World Index ex-USA, everybody except for the United States. Okay, I know, I get excited about them. Slide number 22. Have you heard the terms bull market, bear market? I sure hope so. A bull market, investors are optimistic, more investors are buying stocks, the stock market increases, standard of living is going up, people are getting raises. Why do they call it a bull market? Because bulls charge ahead and they throw their opponents up in the air. Right? Bear markets, everybody's sad, investors are pessimistic, more investors are selling stocks. Now, a bear market is officially when it goes down 20% or more versus a market correction, which is 5, 10, 15%. What's the difference? Well, 20% is a pretty big jump down, but it happens a lot more than people think it does. Historically, it's happened every 4 or 5 years or so. Hasn't happened since 2008, folks. Got close, got down to 12, 15% a couple of times, but no, it has not gotten to 20% since the Great Recession. And so we know it's going to happen. I don't know when it's going to happen, but we know it's going to happen. But people say, you think it's going to be a crash? I say, yeah. They say, oh, what should we do? What should we do? No, nothing. I mean, I don't know when it's going to happen. I mean, knew it was going to happen. It wouldn't be the future, and I could make a ton of money if you could go back in time, but you can't do that, and that's not the way the world works. Oh, by the way, why is it called a bear market? Well, everybody will tell you it's because bears they're more reclusive and they tend to knock down their opponents with their claws. But that's not the real reason, but you can use that reason. The real reason's even weirder, so we won't go into that. Slide 23. All right. It's time to do our stock analysis. Where do you start? Well, let's start with some of the most popular measures of stocks. And as Benjamin Graham, the author of The Intelligent Investor, Warren Buffett's teacher, by the way, said, show me the numbers, right? Right out of a movie. And some of the more popular over the years have been these that we're going to go through over the next few slides. Capitalization, book value, earnings per share, price to earnings ratio, dividend yield, current yield. They are the most popular and, certainly a great place to start, but it's just the beginning. But as I said, and I'm going to say it again before we leave, I hope to show you that this stuff is not as hard as people make it out to be, and that you too can look at a company, look at their statistics, and say, yeah, I see this, and that. I see that. This could happen, that could happen, so that you have your eyes wide open before you invest. Now, I certainly hope that if you do decide that you want to buy individual stocks, you would take a course such as BUS121, Introduction to Investments, or, educate yourself or take a class at some other college. It's not going to be good as ours, of course, but I'm not biased or anything. But definitely, because it's tricky, and you really need to have your eyes open and not just follow the crowd, because we see what happens when you follow the crowd. Right. Okay. So let's get started, huh? Okay, slide number 24. Capitalization. Huh? Capitalization is a fancy word for how much is the company worth. You see, people concentrate on the stock price, but you don't know what the company is worth unless you know how many shares there are. So it's a very simple formula. The number of shares out there, outstanding, it's called number of shares that are out in the world, multiplied times the current price of the stock. And that's what the company is worth according to investors, because the investors are buying and selling the shares at that price, and they're saying this is what we think the company is worth. And we'll take a look at the example, and there's a worksheet that you're going to work through on your own, and don't worry, there's an answer key, and we do it in the face-to-face class together, and there's a commentary. So there are three major categories: Papa Bear, Mama Bear, and Baby Bear. Large cap, mid cap, small cap. There are a few subcategories that you can take a look at, but these are the ones I want you to remember. And a large cap company is anything above 10 billion or so of market worth. Exactly. So remember that. 10 billion or higher large cap. Now there's a subcategory of the large cap called mega cap. These are companies that are worth hundreds of billions of dollars. Google, Apple, Walmart, Exxon, GE. Exactly. And but you don't have to remember that. As long as you remember large cap, that's good enough. Mid cap are company, and by the way, most of these large caps, you've heard these companies. They're name brand, household names. Some of them aren't, but most of them are. Mid cap stocks. These are companies, some of which you've heard of, a lot of them you haven't. Anywhere from $1 or $2 billion. Now it depends on who you talk to. $2 billion for some people is where it starts. $1 billion is where it starts for others. Upwards of $10 billion. They're the mama bears. And then the baby bears are the small cap stocks. Anything less than $1 or $2 billion. Why do we say 1 or 2? Because some people think 1 billion is where it stops, and other people think it's 2. But small company stocks, most of which you've never heard of these companies, some of which you have, but maybe because they're local. Once you get below about 100 million, then you're in what's called the micro cap world. It's a subcategory of small cap. So I don't remember again. I don't care if you don't remember that. You don't have to remember that. What you have to do is remember large cap, mid cap, and small cap. And then there are the penny stocks. Thousands of them with, just outrageously small market capitalizations because they're really not worth anything. They're just a shell, a sham. So we shouldn't even mention those in polite company. So here's an example. If I have a company whose price is $50, what's the company worth? Well, I don't know. Right? I have to know how many shares there are. So I look up how many shares there are. There happen to be 2 million shares. And I multiply 50 times 2 million and 2 million, and I get $100 million of market capitalization. So is this a mama bear, papa bear, baby bear? It's a baby bear. It's a small cap stock. The stock price, dear students, for the most part is irrelevant until you get into the penny, and then it's very important. It means it's a scam. You must look at the market capitalization to see what the company is worth. And we'll take a look at some real-life examples in a bit. Slide number 26, the book value. Do you remember net worth statements? Assets minus liabilities? Well, the net worth is determined by deducting all the liabilities from the corporation's assets and dividing the remainder by the number of shares outstanding. What does that mean? In other words, if you were to liquidate the company, sell all the assets, pay off all the debts, how much would be left? And it's rarely close to the stock price. It's often 1/5 or 1/6. Sometimes it's close to the stock price, but not usually. Why? Well, think about it, folks. A successful business is worth much more intact than if it were liquidated. Look at a pizza shop. I mean, what's the pizza shop worth? It's worth far more than the pots and the pans and the tables in the kitchen. I mean, yeah, the fact that it's making money means that it's worth a lot more than the assets on the books. Now, here's what happens. If a stock is whatever, for whatever reason, the technology is beating it up or whatever, or their competitors are beating it up. if the stock price goes lower than the book value, there is a danger of the company being raided for the assets and put out of business. They're called corporate raiders, takeover artists, private equity firms. What they do is they see a company that's, for whatever reason, still has plenty of assets on the book, but the stock price is going lower and lower and lower because investors are not happy with what's going on with the business. They will whoosh in, buy up the shares, sell all the assets, pay off the debts, and walk away with money in their pockets. And oh, by the way, they lay off all the employees. Now, how would you feel if that were your company, someplace you worked at for 22 years? You'd be pretty darn pissed, right? You'd be very angry. Because what are these and some of them, one of them ran for president in 2012. That was Mitt Romney. He worked for Bain. Don't you like that word, Bain? Bain Capital. And that's what they would do. That's their job. And people will complain to their politicians, and politicians want to get elected, and they'll make noises like, we have to do better for our employees, and they'll say all these great things, but really they know, because the economists tell them, that you don't understand. This is capitalism at work. This is how it should work. The capital, meaning the assets, the money, the resources, that was locked in that company was not being efficiently used. It needed to be plowed under, like a field of corn that needs to be plowed under for the next crop. And so that's scant condolence to the people who lose their jobs. But this is why we have unemployment insurance. We don't have unemployment insurance to pay people not to work, folks. We want them to go find a new job. And here, in the meantime, here's some money to help you through to find a new job, because that company needed to be plowed under. Does that make sense? I hope so. It doesn't make it any easier for the people who lose their job, but it makes for a more efficient economy, and that makes for a better standard of living for everybody. And it sounds like I'm running for office, which I'm not. I'm not running for office. I just believe that we have to make this system the best it can be, because, as we said, it's the worst possible system, except for all the others. Slide 27. Now, here are two statistics that are very important. Earnings per share and price to earnings ratio. The earnings per share lets you look at your stock, your one share of stock, as if it were a little business. What is my stock making for me? How much money is it making? Because what you do is you take the after-tax earnings and divide it by the number of shares. And what investors often do is they look for growing earnings. Remember the growth stocks? The price to earnings ratio then relates that those earnings, back to the price of the stock. And a lower price to earnings ratio means the stock is less risky. A higher price to earnings ratio means the stock is more risky, but at the same time it also tells you that investors are more excited about the opportunities for that stock with the higher price to earnings ratio. We're going to see some examples in a bit if it doesn't make any sense. But think about it, folks. Why do you want to own a business? To make money. So isn't it good to know how much your share of stock is making and how much you had to pay to earn that? Yeah, and that's what these two statistics tell us. So let's take a look at some examples. The company earned $2.5 million. Well, to you and me, that's a lot of money, right? But to a company, that might be pittance, right? They blow that on a Super Bowl ad. But we don't know the earnings per share until we know how many earnings are out there. So in this case, the company had 5 million shares outstanding, we say. 5 million shares out in the world being traded amongst investors. So you take the 2.5 million and divide by 5 million. I know some of you, my calculator doesn't have that. Just cross off all the zeros, right? Cancel the zeros, as it's called. I hate that word, cancel. And you wind up with 50 cents. And that means every share that you own has earned 50 cents. Like a little factory, a little business that earns every share earns 50 cents. Cool? And what you as an investor are often looking for, are companies that are growing their earnings. Now, some are growing their earnings very quickly. They're the growth stocks, and some of them are doing it slowly but steadily. I like the slow and steady, folks. But everyone's different. That's why there's chocolate and vanilla, and some people like strawberry. And you can always have all three. Slide number 29. Now, let's relate those earnings for that stock back to the price. Let's say that company that was earning 50 cents a share has a stock price of $10. Then we take price divided by earnings, PE, that's what it's often called, and it's written often as P/E or just PE. You take $10, the price, divided by 50 cents the earnings, and you get 20. Now don't put a dollar sign, don't put a percent sign, it's unitless. So 20. What does that mean? I don't know. Well, let's take a look. It actually does mean something. Slide number 30. Historically, a PE ratio of 20 or above was considered high and reserved only for the fastest growing stocks, the growth stocks. 5 to 15 was considered average. Well, right now, 15 is about average. And for almost 30 years, a PE ratio of 40 or 50 was not uncommon amongst growth stocks like Starbucks and Google. It's actually a lot higher for Google for a while there. And then I will never forget this, folks. I looked down at the computer screen in 1998, late 98, or not 99, I think it was. And I just saw eBay's PE at 10,000. And I said to myself, this isn't going to continue. I don't know when it's going to fall, but it's going to fall hard. And I was right, but you just didn't know when. I didn't think it was going to happen in year 2000. I thought I was going to wait a couple of years, but no, boom, it hit it really hit in 2001 and 2, but it started falling in 2000 and then 2001 and then 2002. Yeah. So we're looking for an average about 15 or so. That's average, 12 to 18. 25, 30, that's high. And then you see some companies with really high PEs. You see some companies with really low PEs. Now that can be dangerous too, because that usually means that investors are running away from that company. That was GE in 2006 at a very low PE because it was still earning money, but its price kept falling and falling and falling because investors were getting hip. You better get out of GE fast, and they were right. It had a low PE because people thought it was going to fail, and it turned out they were right. So slide number 31, dividend yield. The dividend yield harkens back to our discussion about dividends when we are paid for owning the stock, the distributions of the earnings. And this allows us to compare a stock to a savings account or a bond, because you take the dollar amount of dividends and divide it by the stock price. And as we said, dividends were in the 4, 5, 6% range for decades and decades because stocks were considered so risky. But then in the 1980s and 1990s, they went down to 1%. That was right before the bear market of 2000 to 2002. Many companies are paying 2-3%. Some are paying 0. They pay no dividend. They're returning the money and putting it back in the company. And others are paying 4 and 5% or more. So you really have to sniff around. And here's an example here. This company is paying $1.40. $1.40 in dividends. The market price is $87.50. Well, if we take the $1.40 and divide it by $87.50, we wind up with 0.016 or 1.6%. And you can write it either way, folks. But we like to see at least 3 or 4. Well, this one works out evenly to 1.6%. But we like to see 3 digits or so, 4 digits. So is that high? No, it's on the low side, but still it's better than what a savings account is paying at a bank or a credit union, isn't it? Yeah, it is. But what's the difference? Right. The bank or the savings account, that money is guaranteed. Is the 87.50 guaranteed? No. Tomorrow it could fall to $50 or go up to 100, or in the case of a company going bankrupt, it can become worthless. Stocks are risky. So now that we've taken a look at some of the different types of measurements that we can make on stocks, we can use for stocks, let's take a look at some companies that you may or may not have heard of. Have you heard of these two little mom and pop grocery store shops, Walmart and Costco? Yeah, okay. Now, if you just looked at the price, which is what a lot of people do, many people do, you'd think, wait a minute, is Costco bigger than Walmart? No. You intuitively know that Walmart is the world's largest retailer. But the price has nothing to do with anything until we know how many shares there are. We'll deal with that at the very last measurement. But let's take a look at their earnings per share. $4.38 for Walmart, $5.42 for Costco. Costco's actually earning a little bit more than Walmart, but the price is a whole lot more. So when we look at the price to earnings ratio, we see that Walmart is 16.5, whereas Costco is 31, almost twice as much as Walmart. Now, what can we discern from this? What can we take away? What's our takeaway, so to speak? What can we know? Well, what we can understand is that investors believe that the future for Costco is brighter than it is for Walmart. They are more happy, more excited, more enthused about Costco's future than Walmart's future, because they've bid up the price relative to the earnings at almost twice the amount. Because 16.5 is about average. It's a little on the high side historically, but now it's not a big deal. But 31 is pretty darn high. So are investors correct? Well, we'll know in 3 to 5 years when everything has changed. So that's the problem with investing. As Warren Buffett likes to say, investing is simple, but it ain't easy. Investors believe that Costco has more room to grow, so to speak, but are they right? You pays your money, you take your chances. Looking at the book value, you see that the book value in both cases is far less than the price. No one's going to sell all the assets of Walmart or Costco, pay off all the debts and walk away, because first of all, it wouldn't make any sense. You'd lose a lot of money. And secondly, no one can afford to buy either of them. They're very expensive. And that's what we know about most companies, that they're in business to do business and they're worth more intact. Now, what are the dividends per share? Well, Walmart is paying $2.04 per year for every share you own, and Costco is paying $1.80, which is pretty darn close. But remember, you only had to pay $72 for Walmart, $168 almost for Costco. So the dividend yield for Walmart is much higher than Costco. 2.8% for Walmart, which is very generous, almost 3%, a whole lot better than your savings accounts are paying. And Costco's paying 1.1%, which is almost 1/3, right? The amount that Walmart is paying. So obviously, investors are more interested in the capital gains that they believe are available, are potentially available with Costco, than they are for Walmart. So the Walmart investors are more interested in the dividends. Are either of them right? Well, we'll see in 3 to 5 years. Now here, there are some 6 billion shares. I forget how many. There's a lot of shares of Walmart, and I forget how many shares of Costco. But yes, Costco is 3 times worth more than. I'm sorry, Walmart is worth 3 times more than Costco. $222 billion. Yeah, that's a mega cap stock, whereas Costco is still a large company at almost $74 billion, but not a mega cap yet, and that's maybe why the investors are they're more interested in Costco, because they believe it's going to make it to the mega cap world. We'll see. Okay, next one. McDonald's and Yum. Who are Yum brands? Well, you know them as Kentucky Fried Rat, Taco Hell, and Pizza Crap. Yes, dear students, there's a whole lot of money to be made selling people sugar, fat, and salt. Do you think people will ever wake up to the fact that they're being sold garbage? No, they're going to eat it, and you're going to make a lot of money if you invest in either of these companies, actually. Well, that's not a guarantee, but they've done well in the past. McDonald's, 131, Yum, 64.5. Well, it turns out that no, it's not twice as big. It's like almost 5 times as big as Yum, McDonald's is. So the earnings per share, $5.44, Yum, $4.04, and the PE of McDonald's is 24, the PE of Yum is 16. So what do we know? Investors are more attracted to McDonald's than they are Yum brands. And it was the other way around for many years, because Yum brands was just kicking McDonald's butt left side up, upside down in China. Because it turns out the Chinese like chicken more than they do beef. And everything was going swimmingly well for Yum brands until something completely out of their control happened, the bird flu. And dear students, there has never been a documented case of a human catching bird flu from a dead cooked chicken. The bird has to be alive for the human to catch it, but that didn't matter. People just flocked, pun intended, away from Yum brands. And it's a long story. It turns out that they actually broke the company into two. There's a Yum China now, because they're regrouping and they're coming back strong. And so the Yum brands, the company split in two. And so this company, it just is not the Chinese Yum brands. So it's a very interesting case study that we may or may not look at in Business 123 Introduction Investments. Look at the book value. Right, negative. In other words, their debts exceed their assets. Yeah, no one's going to buy McDonald's or Yum for their assets because they got to pay off the debts. $3.76 per share for McDonald's, $1.20 per share for Yum in dividends. And so McDonald's is paying a very healthy dividend, 2.9%. That's pretty darn good. A lot better. It's better than the 10-year Treasury bond, which is what, 2.4%. Yum is 1.9%. Not as much, but still not bad. Better than your savings accounts. But remember, the stocks are not guaranteed. But again, are people going to stop eating McDonald's and Yum? I don't think so. I wish they would, because that food is killing people. It's creating diabetes and making us overweight. But I'll just get off my soapbox. Okay, market cap. Yes, McDonald's is broken into the mega cap world, $108 billion, and Yum is $22 billion. So even though Yum is still a large company, it's much smaller than McDonald's. Yep, okay. And if you had looked at it a few years ago, you would have seen that people were more excited about Yum than they were McDonald's, but that's why it's a marketplace. Things change. This was when McDonald's was having a hard time getting people excited about their menu, and then what they did, they made breakfast available all day long. I don't know. I don't go there. I just smell the place and it makes me sick. I'm sorry. I apologize. I told you I'd insult everybody by the end of the semester. Slide number 35. AT&T and Verizon. You ever heard of these guys? Yeah, the duopoly. Sprint and T-Mobile they're gaining ground on these, but they're still both very small compared to AT&T and Verizon. So you look at the price and you think, AT&T is a little smaller than Verizon? No. $41.62, $49.31, earnings per share $2.10, earnings per share $3.21 for Verizon. So AT&T's PE is almost 20. Verizon is still 15.4. Verizon's middle of the road. AT&T a little high, but these days not really that high. $20.06 book value, $5.53 for Verizon. No one's going to try to buy these and pay off all the assets. I mean, pay off all the debts and sell off all the assets. Dividends per share, $1.96, $2.31. Look at that dividend yield. Look, 4.7%. 4.7%. Folks, this is more than AT&T and Verizon are paying for their bonds. Yes. I mean, it's amazing. And I don't understand why people are not more excited about either of these companies, because do you think people will ever give up their mobile phones? Well, when something else comes along and we don't even need a mobile phone, it's built right into your head. I don't know. I don't know when that's going to happen, but it's going to happen eventually. So in the meantime, I wouldn't mind collecting 4.7%. Now, right, that's not guaranteed. Next quarter, either AT&T or Verizon could cut the dividend to zero if they wanted to. They won't. And look at the market cap. $256 billion, $202 billion for Verizon. They're both mega cap companies. So now, what can we glean? What can we take away from these measurements? What we can see is that stock analyzation, stock analysis, is really not as hard as people make it out to be. Once you understand these measurements, you can look at a stock with your eyes wide open. Now, is that going to make you a phenomenal stock picker? Maybe, maybe not. No, not necessarily, because it's all about the future. And does anybody know what's going to happen in the future? Could anybody have seen that the bird flu would stop Yum Brands in its tracks in China? No, that's why we diversify. As when we discuss diversification, we'll discuss it some more, especially when we get to mutual funds. So I hope you're enjoying our journey along stocks, right? Because in our next presentation, we've got more for you. You excited? We're going to be looking at investment theories and strategies in our next presentation. See ya!